Hi, I'm Onshore. Welcome to Digging into China, where we explore China in depth to reveal unique perspectives. Isn't the renminbi a currency manipulated by the Chinese Communist Party? Why then does it continue to depreciate so sharply? What's driving this ongoing decline? Does the CCP prefer the RMB to appreciate or depreciate? And what's the likely trajectory for the currency? In today's program, I'll explore these questions about renminbi. Recently, the renminbi's exchange rate against the US dollar has been in a steady downward spiral. Despite being an integral part of daily life in China, the RMB remains one of the least understood aspects for many Chinese people. If it's indeed under the CCP's control, why is it still falling so relentlessly? To understand the issue of exchange rate manipulation, we first need to delve into the nature of the RMB. The RMB is a complex and contradictory currency. Generally, currencies can be categorized as either freely convertible or non-convertible. Major international currencies like the US dollar and the euro are freely convertible, meaning holders can exchange them without restrictions, and their exchange rates are determined entirely by market forces. In contrast, currencies such as the North Korea Yuan or the Cuban peso are classic examples of non-convertible currencies. These cannot be exchanged freely, and their exchange rates are dictated entirely by official policies. However, their actual value is often determined by black market activities rather than official rates. Where does the renminbi fit in this framework? It occupies a middle ground, combining characteristics of both freely and non-freely convertible currencies, making it partially convertible. This unique status stems from its dual-track system, onshore renminbi and offshore renminbi. What distinguishes onshore from offshore renminbi? Both are the same currency, but the key difference is their location. Onshore renminbi circulates within mainland China and is held by domestic population. Transactions involving onshore renminbi are heavily regulated by the Chinese Communist Party. Currency exchanges are restricted, and its exchange rate is influenced by the central parity rate set by the People's Bank of China. This control aligns onshore renminbi more closely with the characteristics of a non-convertible currency, making it firmly under the CCP control. Offshore renminbi, on the other hand, refers to renminbi traded outside mainland China, with Hong Kong as its primary hub, followed by markets in Singapore and London. Being outside China's mainland means offshore renminbi faces fewer restrictions. It is not bound by the central parity rate, allowing for freer currency exchange and additional market-driven operations. For instance, direct short selling of onshore renminbi is largely unfeasible due to regulatory barriers, but offshore renminbi markets face no such restrictions, making them more influenced by market forces. This dual-track system highlights two competing forces driving the renminbi's exchange rate. Offshore renminbi reflects market dynamics to a greater extent, while onshore renminbi is more tightly controlled by the CCP. The two forces, while opposing, are deeply interlinked. For example, offshore renminbi, despite being traded abroad, remains anchored to the onshore renminbi. Meanwhile, the CCP cannot allow onshore renminbi to deviate too far from market-driven expectations. If the gap between onshore and offshore renminbi prices widens excessively, it risks decoupling the two entirely. Such a decoupling could cause systemic turmoil, transforming offshore renminbi markets into unregulated black markets and undermining the renminbi's credibility on the global stage. The interaction between these two forces shapes the trajectory of the renminbi, positioning it as a currency in the middle ground. It is neither as freely convertible as the US dollar, nor as entirely state-controlled as the North Korea won or Cuban peso. However, in the current context, the dominant force influencing the exchange rate remains the onshore renminbi, which continues to play a leading role in determining overall trends. How does the CCP control the value of the onshore renminbi? The primary mechanism is through the central parity rate, which is a cornerstone of their control strategy. Every trading day at 9:15 a.m., the People's Bank of China sets a central parity rate for the renminbi. This rate acts as a reference point, with the daily fluctuation of the renminbi limited to a 2% range above or below it. If the exchange rate exceeds this range, trading is suspended, similar to stock market circuit breakers. In principle, the central parity rate should be determined by various factors, such as the previous day's closing price for the renminbi, much like a stock market openings reflect the prior day's close. However, in practice, this rate is influenced by a less transparent mechanism known as the currency cyclical factor. While the specifics of this factor are complex, it can be understood as a tool the CCP uses to adjust parity rate in ways that align with their broader objectives. By leveraging the central parity rate and the counter-cyclical factor, the CCP manages to steer the renminbi's exchange rate. This approach allows them to maintain control over the currency's value, ensuring it serves their strategic needs, even if it diverges from purely market-driven pricing. To gain a clear picture, let's examine the recent trends in the renminbi exchange rate. The currency has been depreciating, with the exchange rate against the US dollar rising from 7.2 at the end of last year to over 7.3. However, the central parity rate set by the PBOC has remained unchanged. By fixing this rate, the central bank has been able to control the daily fluctuations of the renminbi. Currently, the central parity rate is just under 7.2, which means with the 2% daily movement limits, the onshore renminbi can only fall to a rate of 7.3328 against the dollar. The exchange rate is currently hovering around this threshold. By maintaining control over this central parity rate, the CCP ensures that onshore renminbi stays within its managed range. However, as mentioned earlier, there is also the offshore renminbi. If the CCP continues to control the onshore renminbi strictly, the question arises, what if the market causes the offshore renminbi to break free from this control? That would create an unstable situation. Therefore, some market-driven interventions are necessary to manage renminbi. One of the primary ways to control the currency is by limiting the renminbi's convertibility. Since 2015, China has imposed tighter controls on capital outflows, making it difficult for companies to exchange foreign currencies. Personal foreign exchange transactions have also been subject to increasing restrictions, with lower limits on the amounts individuals can exchange and a stricter approval process. By reducing the amount of renminbi available for exchange, these measures help support the currency. However, their impact is gradual and not immediate. Another more direct approach is to adjust the foreign exchange reserve requirements for banks. Here is how it works. If the reserve requirement is 6%, a bank with $1 billion in foreign exchange deposits would be required to hold $60 million in reserves. If the reserve requirement is lowered to 4%, the bank would only need to hold $40 million in reserves, freeing up $20 million to be sold in the market. Conversely, if the reserve requirement is increased, banks would need to hold more foreign currency reserves, which could prompt them to buy foreign currency and sell renminbi, putting downward pressure on the renminbi's value. Through these methods, the CCP is able to exert influence on the exchange rate and stabilize the renminbi to suit its economic and political goals. In addition, China has recently taken another step by issuing central bank bills in Hong Kong. The strategy behind this is to absorb offshore renminbi liquidity in Hong Kong, effectively draining the market of offshore renminbi. This makes it more challenging for the market to short the renminbi, helping to stabilize its exchange rate. Along with this measure, China has also been lowering its foreign exchange reserves and buying renminbi with US dollars, among other actions. Overall, while the renminbi faces considerable downward pressure, with the onshore renminbi still constrained by the 2% fluctuation limit set by the central bank, the CCP's ability to control the currency remains strong, with various tools available to manage the exchange rate. Now that we've covered the CCP's control over the renminbi, let's turn our attention to the currency's movements. There are two key factors to consider: the market and the CCP. First, let's examine the market. Right now, the market sentiment is overwhelmingly bearish toward the renminbi, with forces driving the currency downward. Where does this bearish trend come from? On a macro level, it's primarily due to the poor economic environment in China. On a micro level, it reflects the lack of profitable investment opportunities, meaning, simply put, there is no money to be made. This is most clearly seen in the government bond market. The logic behind the bonds is somewhat counterintuitive. The more people buy bonds, the higher their prices go, but the yields fall. Despite the Chinese government's repeatedly urging people not to buy bonds, the market has continued to purchase them. As a result, bond yields have steadily dropped, with the 10-year government bond yield falling to a low of 1.6%, even below Japan's stagnating yields. This is because China struggles to find better investment opportunities, and it's increasingly difficult to find projects with higher returns than the 1.6% yield from bonds. The low yields on bonds and the deposits highlight the overall low returns in the country. At its core, it shows that the returns on renminbi assets are weak. Whether money is placed in banks for interest invested in the stock market or funneled into business, there's little chance of generating substantial returns. With such low returns, investors are increasingly choosing to move their capital out of the country, especially with concerns about China's stability. Normally, China's government bond rates, bank interest rates, and private investment returns should all be higher than those in the US in order to maintain exchange rate stability. Some might argue that this situation should actually result in the renminbi appreciating, as the returns on renminbi assets are higher than those of US dollar assets. However, this situation touches on the concept of a country's credibility. As a developing nation, China faces instability in its legal system, democracy, and government credibility. If interest rates in China were similar to those in the US, investors would hesitate to keep their money in China. It's like comparing the Bank of China to a rural cooperative bank. If the rates are the same, you would naturally choose the more stable Bank of China. At present, China's government bond yields and the bank interest rates are significantly lower than those in the US. And in terms of government credibility in financial markets, China lags behind the US, driving capital outflows. When capital exits, investors convert renminbi into US dollar, putting sustained downward pressure on the renminbi. Now, turning to the central government's stance on renminbi depreciation, it is clear that they have a mixed view. On one hand, they disliked ongoing depreciation as it undermines Xi Jinping's vision of the Chinese dream. In terms of renminbi-based GDP growth, China has seen decent figures, around 5% annually. However, as the renminbi depreciates, China's GDP, measured in US dollars, shrinks and it has even seen negative growth. This results in China's global economic share dwindling, as international metrics are mostly calculated in US dollar. The depreciation of the renminbi reduces China's international standing, directly threatening Xi Jinping's ambitions for global dominance. It also erodes the purchasing power of Chinese citizens, diminishing their living standards, which in turn could foster dissatisfaction and complicate the CCP governance. Yet, on the other hand, the CCP may see the depreciation as a tool with certain advantages. The most obvious benefit is that it helps to counteract tariffs. If the US imposes a 10% tariff on Chinese products, a 10% depreciation in the renminbi would effectively neutralize that tariff. Although there may be complications such as rising raw material costs, the depreciation remains one of the CCP's key strategies for addressing tariffs and trade wars. After discussing the government and the market perspectives on the renminbi, let's look at its potential trajectory in 2025. Depreciation is almost certain, but the extent of that depreciation will depend on both the Chinese government's resolve and the actions taken in ongoing trade war under Trump. So, why is depreciation inevitable? This is largely due to the current economic fundamentals. The low returns on investment in China are not just a result of a weak economy, but also a consequence of President Xi's policies. His focus on mass production in sectors like electric vehicles and a chip, driven by the belief that production determines everything, has led to massive overcapacity. This overcapacity creates unsold goods, prompts global opposition, and forces corporate profit margins to remain persistently low. As long as Xi Jinping continues to pursue this production determines everything approach, in 2025, corporate profits will not recover in the short term, no matter the outcome. With profits stagnating, bond yields, bank interest rates, and the returns on renminbi assets will all remain subdued, leading to further depreciation of the renminbi. On the other hand, the US economy is currently performing exceptionally well, with indicators like employment consistently surpassing market expectations. This diminishes the likelihood of a rate cut in the near future. By 2025, China and the US will be operating at the opposite ends of the spectrum. The US overheating and China cooling. The US may want to cool its economy, which could lead the Federal Reserve to lower interest rates, but that seems unlikely. China wants to heat up its economy and raise interest rates, but that won't be feasible either. This stark contrast between the two economies will inevitably put intense pressure on the renminbi, leading to depreciation. Additionally, the CCP may actually welcome some renminbi depreciation, given that Trump's trade war seems almost certain to resume. As mentioned earlier, depreciating the renminbi is an effective countermeasure. The reason the renminbi hasn't depreciated quickly against the US dollar is due to the CCP's control over the currency. Despite significant market pressure, the CCP has maintained the renminbi's central parity rate at around 7.2, likely waiting for Trump's return. They are holding off on taking actions until they see his next steps. If Trump imposes a hefty 60% tariffs, the CCP will likely devalue the renminbi quickly by adjusting the central parity rate. However, if the tariffs are only slightly raised, the renminbi may not see significant depreciation. Given the current situation, At a minimum, Trump is likely to impose a 10% tariffs on China. With this level of market pressure, the renminbi exchange rate could rise to around 7.5 to the dollar. However, if tariffs exceed 20% or even reach 60%, the renminbi could experience significant depreciation, potentially falling to 8 to the dollar. While I am generally bearish on the renminbi long term, predicting it could eventually drop to 10 or lower, focusing specifically on this year, I believe the renminbi would only depreciate to around 8 if Trump were to impose a 60% tariffs. This is primarily due to the fact that the CCP still controls and stabilizes the renminbi. Even if they want to devalue it, Xi Jinping is unlikely to allow it to depreciate so drastically all at once. A sharp drop to 10 would be catastrophic for China before the trade war is even resolved. If the renminbi does eventually reach 10, it will likely be a gradual process. Regardless of the trade war's outcome or the specific tariff rates Trump imposes, renminbi depreciation is inevitable in 2025. Therefore, I advise everyone to quickly reduce their renminbi assets. You may consider shorting the renminbi, or if that's not possible, converting renminbi into other assets such as US dollar, gold, or cryptocurrencies to safeguard your wealth. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.